Hey guys, it's Mr. Schmidt here, and in this video we're going to actually calculate gross domestic product, or GDP. In the last video we defined GDP and explained that it's the total value of all final goods and services produced within a country's borders in a given time period, most often a year. But now I want to talk about that value part. How do we actually calculate that total value? Well, there's actually three different approaches to do so. The first one's called the income approach, which adds up all the income earned from producing goods and services. So if I go and sell a good and service, what is the income I earn from that? Add all that up, there's GDP. The expenditure approach looks at the spending side of the equation, right? So what are people spending their money on, whether they're firms, governments, consumers, foreigners, whoever the case may be. Add all the spending up, and that should equal GDP, because after all, someone's spending, is going to be another person's income. That money's going to flow from the spender to the person receiving the income, and so they should be equal. Same thing with the value added approach, which actually goes back to what we talked about with intermediate goods. Remember the car, we said we don't count the tires, but we count the whole car. The value added approach looks at that and says, okay, what if we, took each individual part of the car, we broke it down, we said, okay, we're going to take the tires and add the value of that to the value of the radio, and then we'll add that to the value of the metal used to make the car, and we'll add up all of those pieces together, and then there's GDP if we do that for every good and service in the economy. And so it doesn't really matter which approach a government uses to track GDP, they all should get to the same value in theory. But the one we're going to spend our time on, and the one that you definitely need to know for the AP exam, is the expenditure approach, which looks at the spending side of the equation. And so that's what we're going to do here in this video. So GDP is calculated using the expenditure approach by summing up four components together. We have consumer spending, which is represented by a C, business investment, which is represented by an I, government spending, represented by a G, and net exports, which is represented by an NX. And so what I put in blue here is kind of the magic formula for the expenditure approach, GDP, which, by the way, GDP often is abbreviated with the letter Y. We already have G being used for government spending, so just get used to GDP being a capital Y. It's weird, it's what we use, just go with it. It's equal to C plus I plus G plus NX. Memorize that formula. Commit it to memory, make a flashcard, Quizlet, whatever you got to do, because it is so very valuable to know this formula. So now that we know the four components, I want to define each one in slightly more detail. So consumer spending is spending done by individuals on final goods and services. So for example, if I go to Subway, get a $5 sandwich, that will be included in consumer spending. So what you and I do when we go to a store and we buy something, that's consumer spending. It's spending done by consumers, right? The next one is business investment, and I want to be very, very careful with this one. This is spending done by businesses on final goods and services. So for example, if a business needs a hammer and they go and buy the hammer for their business, that is business investment spending. It is not stocks and bonds. That is not what we mean by investment. When we say investment in economics, we are really meaning investment spending. It's when businesses do spending, when they pay money to acquire goods and services to help run their business. So just be very, very careful with that word investment, because to quote The Princess Bride, I don't think it means what you think it means. Business investment also includes inventories. Inventories are goods produced and held in storage to be sold at a later date. Because, face it, when a business makes product, they're not going to sell all of it immediately, right? So they have to hold on to some of it. Whatever they're holding on to, it is counted in the year it is made, right? Because years later, it's basically going to be in the same category as used goods, right? You count it in the year it's produced. So inventories are counted in the year they are produced and are included in the investment spending category of GDP. Another one that I'm going to go ahead and mention here is housing. So if someone buys a house, that is considered investment spending because people tend to sell their houses later. So a new house being bought and sold, that is investment spending. Now, if it was a house that had already been produced or built in a previous year, then it would not be counted for the year it was sold. It's always counted in the year it's produced. That word produced is so important. It's gross domestic product. When is it produced? Where is it produced, right? All of that matters. Third, we have government spending, and this is just like what you think it is. It is spending done by the government on final goods and services. So, for example, if the government buys a tank for their military, that's government spending. The one caveat I would include here is it does not include transfer payments. Remember, transfer payments is money the government basically takes out of their own account and gives it to consumers, individuals. That's not included in government spending because it's not included in GDP. Nothing of value is being produced here. It's just money moving around, much like a stock or a bond. The final category with net exports talks about something that we really haven't mentioned that much in the course, and that's trade, right? Net exports is equal to exports minus imports. So an export is anything one country sells to another country, right? So if Japan sells a PS5 to the United States, that is an export for Japan. And it adds to the country's GDP, right? And that makes sense because GDP is about what you're producing. And if you're producing something and then selling it somewhere else, great, that's a positive for your country. Imports, on the other hand, subtract from GDP, right? From a country's GDP, because it's what one country buys from another country, right? So my PS5 example, the US would be importing the PS5, and it would subtract from net exports and from GDP because it's not something we produced. It's something we bought from somewhere else, right? And so it would subtract from our GDP. So countries are always trying to make their exports way, 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 way larger than their imports or greater than their imports so that they can have a positive trade balance and have a positive contribution from this component to GDP under the expenditure approach. So once again, GDP is equal to C plus I plus G plus NX. This formula, very important. Bring it to memory, keep it there, and you'll be just fine. So that's all for this video on calculating gross domestic product. Until next time, have a great day.